All right, welcome back, everyone. Today, we are going to cut straight through the modern financial hype machine. Because let's be honest, everywhere you look right now, there's a brand new narrative promising you infinite wealth. From the wild artificial intelligence gold rush to building these massive real estate empires. But what actually happens when we peel back all that slick marketing and just look at the math? Well, in this explainer, we're going to reveal the hidden risks that are lurking right beneath today's trendiest investments. And I'll show you exactly how to protect yourself using cold, hard data.
Okay, let's dive right into this. Here's our roadmap for dissecting the hype today. 1. The AI money furnace. 2. AI as your financial advisor. 3. The real estate wealth trap. 4. Fake advice and influencer scams. And finally, 5. Governments rolling the dice.
So, starting off with Section 1, the AI money furnace, and big tech's trillion-dollar gamble. Look, we are currently witnessing one of the absolute largest capital expenditure cycles in human history, and it is driven entirely by AI. To really wrap your head around the sheer scale of this, just look at this number. $20 billion. That is the staggering amount of cash OpenAI burned through in a single year, 2025. You see, this isn't like a traditional software business where you build a product once and then sell it infinitely at a super high margin. Not at all. Every single query you put into an AI model actively costs the company compute power, electricity, and hardware degradation. Basically, their costs are scaling right alongside the revenues. And this massive cash bun, it's the ticking clock of a rapidly accelerating bubble. And this brilliantly illustrates just how incredibly inefficient this U.S. spending spree really is. The United States is projected to spend a mind-blowing $764 billion this year just on AI infrastructure. To put that into perspective, that's about 3% of the entire U.S. economy. Meanwhile, China is spending just $102 billion. Now, you might look at that and think, well, the U.S. is obviously winning because they're outspending the competition nearly 10 to 1. But the real story is actually a lot more complicated than that. Because here is the harsh reality. American companies are out there burning those billions doing the incredibly expensive foundational research, and foreign competitors are effectively just copying it for pennies. Through a process called distillation, developers can train a new AI model by essentially forcing it to study the answers of an existing, super expensive model. Honestly, it's exactly like copying the smart kids' homework. The result? Chinese open source models are currently offering 90% of the quality of top American models for literally 10% of the price. And you simply cannot make back a $1 trillion investment when your competitors are giving away a nearly identical product at a 90% discount. It just doesn't work. Which naturally brings us to a really critical question. Are retail investors just exit liquidity? I mean, with these massive tech entities bleeding all this cash, how do they actually stay afloat? Well, increasingly, they're turning to the public to fund their deficits via IPOs. When the private money inevitably starts to dry up, or when those early insiders decide it's time to cash out their massive gains, suddenly the everyday retail investor gets an invitation to the party. Now, what's really interesting about this slide is seeing exactly how this plays out in real time. Take the recent SpaceX IPO, which was heavily hyped up specifically for its AI division, XAI. SpaceX hit the market with an absolutely absurd price-to-sales ratio of over 90 times. For some context here, most highly profitable tech giants trade at around 10 times. But it gets wilder. SpaceX reserved up to 30% of its shares specifically for individual retail investors. That is vastly more than the typical 5 to 10% you usually see. So, with insiders facing lockup expirations where they can freely sell their shares, you really have to ask yourself, are everyday investors being brought in to democratize wealth, or are they just being brought in to hold the bag? All right, moving on to part 2, AI as your financial advisor, the danger of hallucinated wealth. You see, the AI hype is coming straight for your personal wallet now, with platforms heavily pushing AI as this perfect 24/7 financial planning tool. And I get it, the pitch sounds amazing. A cheap, completely objective, highly keepable financial advisor in your pocket. But the reality is actually much darker. These things are language prediction models. They're not judgment models. They are notoriously prone to confidently hallucinating facts. Just imagine a 1% hallucination rate when an AI is actively telling you how to invest your life savings. No way. Plus, unless they're registered specifically, these AI platforms operate with absolutely zero legal fiduciary duty to you. So if an AI gives you terrible, wildly inappropriate financial advice that literally ruins your portfolio, right now, there is no explicit legal protection for you. Let's pivot to Section 3, the real estate wealth trap. What happens when the safe asset collapses?
So, if the digital world feels like a minefield, you might be thinking, okay, let's just stick to physical assets, right? The prevailing myth out there is that real estate is just pure passive income, the ultimate safe haven. But the math tells a totally different story, something we call the hidden hassle factor. Local rent caps, like the strict 3% limit out in Los Angeles, mean your income often just can't keep up with soaring insurance premiums and insane repair costs. I'm talking like an $800 bill just to fix a fridge ice maker. Then you add in the 25% depreciation recapture tax when you finally go to sell, plus your state taxes, and your actual annualized return often dwindles down to maybe 4 or 5%. Actually, scratch that. When you factor in your time, you're essentially taking on a stressful, low-yield, part-time customer service job that is just disguised as an investment.
And hey, if you still think real estate values only go up, consider this absolutely devastating figure: $18 trillion. That is the estimated amount of wealth that was entirely wiped out from China's housing market after an agonizing 35 consecutive months of falling prices. So the crucial point here is understanding why this happened in China and impartially looking at why the US market isn't facing this exact same apocalypse today. It's a tale of two entirely different setups. 70% of Chinese household wealth was heavily concentrated in real estate compared to just 25% in the US. China also wildly overbuilt, literally creating massive ghost cities, whereas the US actually has a housing shortage right now of about 1.2 million homes. And finally, Chinese buyers were taking on massive debt for pre-sales, meaning they were buying apartments that hadn't even been built yet, while US homeowners are largely sitting comfortably on 30-year fixed mortgages with record levels of home equity. So the big takeaway here isn't that US real estate is somehow immune to price drops, it's that a complete lack of diversification is absolutely fatal to your wealth.
Okay, Section 4. Fake advice and influencer scams. The rise of finfluencer frauds.
Speaking of danger, let's shift our focus to the people actively trying to separate you from your money right now using social media hype. We are seeing this massive surge in pay-to-pump schemes. Sketchy junior mining companies who often have literally zero actual revenue and no commercially viable ore to speak of are paying creators thousands of dollars to promote their stocks to retail investors. These videos will hype up the stock based on broad macro trends. The stock price artificially pumps for about 30 days as viewers start buying in, and then, yep, it predictably crashes right back down into the dirt, leaving the everyday retail investor holding the bag. And honestly, it is getting even more bizarre. To skirt around disclosure laws and all of that regulatory heat, these zero-revenue companies are actually starting to replace real human influencers with AI-generated videos. They use artificially generated talking heads to read these scripts, pumping their penny stocks on platforms like YouTube. It is a completely unregulated Wild West out there, and it is designed specifically to drain your wallet completely under the radar.
Which brings us to Section 5. Governments rolling the dice. Sovereign wealth or just debt?
So at this point, you might be thinking, okay, the safest bet is to avoid tech, avoid real estate, definitely avoid influencers, and just follow the smart money, like governments. Well, take a look at the recently announced Canada Strong Fund. It's being heavily pitched as a $25 billion sovereign wealth fund. But here is the massive irony in all this. True sovereign wealth funds, like Norway's massive $2 trillion fund, are traditionally built using budget surpluses, excess cash generated from nationalized resources. Canada, on the other hand, runs a consistent federal deficit. This means the government is effectively borrowing money with interest just to launch a highly concentrated infrastructure fund. And the wildest part? They are aggressively pitching this to retail investors to co-invest alongside them. But you absolutely have to consider the severe risks involved here before jumping in. Retail investors who put their money into this face 10-plus year illiquidity lockups. That means you literally cannot get your money out because major infrastructure takes decades to turn a profit. Add in the government's well-known track record of massive cost overruns on public projects and the fact that these types of funds often prioritize political goals over actual market returns, it's a massive, concentrated gamble.
Let's move to our conclusion and see how this all builds together. Protecting your portfolio. We've covered a ton of ground today, from the AI money furnace all the way to government debt funds. So how do you actually survive out there? Well, here is your ultimate math-based survival guide derived directly from our sources today. First up, diversify your assets across sectors. Never, ever tie 70% of your net worth to a single physical asset or single shiny tech stock narrative. Second, ruthlessly scrutinize all AI-generated financial outputs. Verify the math yourself because AI does not care if you go bankrupt. And third, Run away, fast, from unsponsored, hyped-up finfluencer promotions, especially the ones promising you the next big penny stock or some zero-revenue mining company. I want to leave you with this final, somewhat provocative thought. In a market that's constantly driven by aggressive marketing, political narratives, and AI-generated hype, what are you truly investing in? Are you buying based on hard math and diversified risk, or are you just buying into the latest story? Take a hard look at your portfolio today. Thank you so much for joining me on this explainer. Stay focused, stay diversified, and I will see you next time.